technical analysis is the way we review and look at price charts. Everything and anything we do on a price chart is called technical analysis. Whether we're looking at a chart, whether we're putting a trend line or support and resistance line on a chart. So it's easy to refer to this as chart analysis. Now, this type of analysis can give you insight into past movement of cryptocurrencies, helping you to predict what you will see in the future. Now, keep in mind that cryptocurrencies are not tied to any government. There's no economic calendar. There's no economic event. There's no earnings report. So fundamental analysis doesn't really help you with cryptocurrency. Now, the new replacement of that in this world is social media. Now, we've seen tweets like the tweet from Elon Musk last month that saying cryptocurrency sky high and then sent it way back down. And that's a problem because we never know when some person is going to send a tweet. And this is sometimes somebody who's not related really to cryptocurrency, but has a big following. Okay. So that makes a big opening because since we don't have any fundamental analysis, we don't have a jobs report for cryptocurrency. We don't have GDP for cryptocurrency. This is happening on a calendar. We don't have central bank meetings that are happening on the calendar. We have to rely on what we see on the charts, price action, and we have to be able to interpret what we're seeing. So again, to make it less scary, I call technical analysis chart analysis. Almost all technical analysis is performed on charts, and anything and everything we do with charts is known as technical analysis. Now, remember, when you're trading with invest markets, you are getting you're getting the fastest data feeds on their live charts, which means that it's very easy for you to get and make smart, quick decisions. Because technical analysis involves using real-world data to try to predict the future of the market. It involves looking at past statistics of the cryptocurrencies in question, including factors like volume and movement. Now, when you're trading assets, other asset classes, like the euro, US dollar, you have years and years and years of historical data. You know the last time the euro was at 118 a year ago, and then 8 years ago and 14 years ago, what traders did and reacted. Cryptocurrencies are fairly new, so we can only look at short-term reactions. Like right now, we see Bitcoin stuck around in the $35,000 range, and we can see it 30 has been holding pretty good. It hasn't really broken 30. So we have a very strong support level at 30. We've had a huge problem getting over 35. This is only in the last month. 2 months ago, we saw it soar straight up to 60. But that's the only time in history it's been at this level. So how would we look at this and see what's happening? So technical analysis looks at patterns and analytic charting tools to see the strengths and the weakness of the crypto, keeping those in mind for the future patterns. Well, okay, before we go on, let me pop up some live charts and show you what we're talking about in patterns. Hold on a second. Let me go to my live charts. I've got some set up here for you. Okay. So what we're looking at is price movement and to see where price has formed a pattern. Like here, we have on our charts the formation of a triangle. Well, this can help us because we don't know. Now, this happened when crypto was at 1950 and 20. That was a new level for it a couple months ago. So we didn't have anything to rely on a cryptocurrency. So we were looking at, because you can see these lines across are my support and resistance lines. Okay, but you see these that stopped here, here, and here. It's because these were new price levels for Bitcoin at that point. So I didn't have anything to go back to historically. But again, I'm doing it on my chart, and therefore my chart is the only thing I can rely on in my price action. Now, here I have a little chart I put together for you. Now, what you see on the left is what we learn in class. Price moves and eases, moves and eases, moves and eases. But in reality, price is a mess. And this is really how the markets move. Now, my explanation of the markets, and especially cryptocurrency, is the markets are completely random. Okay. They're hard to decipher. They're hard to figure out what's going on. But there are certain periods that the markets exhibit non-random behavior. This non-random behavior is usually a trend up or a trend down. When the markets are exhibiting this non-random behavior, we can make smart trading decisions relying on our charts. So it's important to be able to look at price on a chart and try to understand what it's trying to tell you and how to interpret it. Okay. Now here we have a current chart for Bitcoin, and we can see it's moving in this mess. You see my lines of support and resistance. You see these are my charting patterns. You see where my price estimates are here. You see my moving average. But what we have is just this right now we're seeing lots of random behavior in a very tight range. So right now, 31,931 and 34,962 are the barriers around cryptocurrency. Now, if you're a highly speculative trader, you might jump in and trades up and down between that range. But if you're really looking for trading, we have to wait for a breakout one way or another of this trading pattern. And because the only way you'll ever see that is on your chart, what do we call that is chart analysis. And cryptocurrency is very easy to interpret if you understand and use price action interpretation, because you can see the story in the charts. Now, what we're always looking for is the formation of patterns, triangles, tops, bottoms, inverted head and shoulders, wedges. All of these will help us tell what is about to happen in the market. Now, all of these things that we're looking at are part of technical analysis and chart analysis because they're all taking place on our charts. Now, one of the most important reasons that you have to be able to read a chart is if I said to you that Bitcoin was trading at 32,954 when it opened this morning, went to 32,959, then went down to 31,954, and then went back to 33,972. Could you repeat that to me? Could you make any heads or tails out of that? We do that by looking at our charts. And then when we look at our charts, we start looking for patterns. So here is a chart right now, a beautiful chart of XRP Ripple, where it formed a beautiful triangle and then we got a breakout. So we're always looking for the chart and the price to tell us something. It tells us the psychology of the markets. Here we've combined it with Stochastic's RSI, and what do we get? We get our breakout signal on our charts right here, while we also got an oversold signal from our RSI stochastics. So there's many reasons we want to use chart analysis or technical analysis for our cryptocurrencies. Now, traders of more traditional assets, including stocks, commodities, currencies, and futures, of course, all use technical analysis. The process of using technical analysis on any of those assets will be incredibly similar to that using it with cryptocurrencies. Now, the basis of technical analysis actually comes back from a long time ago. Most of it comes from a gentleman in the early 1900s known as Charles Dow. And he was the founder of Dow theory. Dow theory was the first Dow was the first person to start analyzing the markets using something other than fundamental analysis. And every time you hear about the 50% retracement value, that comes from Dow theory. Part of his theory was when markets move up, they will tend to retrace back 50% of their prior move, which still holds true today. Now, for cryptocurrency, that everything that was part of Dow theory includes current and future and past demand, regulations, expectation of traders' knowledge of cryptocurrency, and more. With technical analysis, traders analyze the price to see what it suggests about the market sentiment. And we're going to be using things, or we use things that are very, very different. We use like total capitalization of an asset. We want to see what the total market value is. It's one of the few places where you can see the whole market value of all of Bitcoin. You can see a whole bunch of traders. You know when the whales are stocking up. You know when they're selling off. You can see when the capitalization of the market is increasing. You can see the actual volume of total cryptocurrencies being traded. So keep in mind that cryptocurrency is not associated with the government or the economy. But cryptocurrency reacts to social media and news headlines in a more volatile manner. And keep in mind, when you're trading cryptocurrencies, you're trading volatility. Now, a lot of us get overly excited when we see, oh, well, Bitcoin went up $3,000 today. I could have made a ton of money. Well, let's bring it down to perspective. If the euro trades at 1.18 and the cryptocurrency trades at 33,000, let's move some decimal points over and let's move cryptocurrency down to $3.30 and the euro's at $1.18. If the euro moves 25 pips, that's about as much as equal to cryptocurrency moving $2,500. But because we can see that big $2,500, we can get really excited. But overall, percentage-wise, it's not moving up. A $3,000 move is what? Is 10% of the value of the cryptocurrency. Now, technical analysis works on the principle that history repeats itself. When it comes to crypto, pricing and trends repeat themselves. Based on this fact that technical analysis aims to make predictions regarding market psychology and the cryptocurrency. Now, granted, the more we talk about and the more headlines we get about Bitcoin, the more it's going to climb. Okay. Yes, we get volatility and we get negativity when regulators clamp down. And China, last week clamped down on all the Bitcoin miners. So you could think of those things as some type of fundamental changes. But ultimately, the more press Bitcoin or Ethereum or the major cryptocurrencies get, the more people jump into the markets. It's not like just because the euro's all in the paper somewhere, are more people going to come in and trade Forex? No. But just remember, a couple of years ago, your parents didn't even know what Bitcoin was. You barely knew it, but you're young and hip. Okay. And most of your friends knew very little about it. And none of them owned it, none of them traded. Now, before you know it, your parents got some of that Bitcoin in their portfolio, or they bought some for their grandchild for his holiday present or his birthday present. And they're more aware of it. They start talking to you about Bitcoin as much as they're talking to you about Amazon now. Now, technical analysis also relies on the idea that movement in the terms of pricing are not ever random. Instead, these price movements follow short and long-term trends. In most cases, when a cryptocurrency follows one trend, it will eventually follow the opposite trend as well. Technical analysts, traders will try to isolate these trends to make more profit. Now, I call it riding the Bitcoin elevator. Basically, with Bitcoin, you get on the elevator, whatever floor you want, and you decide what floor you want to get off the elevator because there's enough volatility. Keep it moving up, moving down, moving up, moving down. It's not like Amazon doesn't go up 50 cents today and then down 50 cents tomorrow and then up 50 cents the next day and the next day. Basically, with the major cryptocurrencies lately, they've had enough that as long as you get on the elevator, and can afford to ride it out. So if you're selling, you'll be fine. If you're buying, you'll be fine. And just ride that elevator and decide where you're getting off and on. And that elevator and the floors it stops on are part of technical analysis because those are your support and resistance levels. Overall, technical analysis cares more about what is happening than why it happens. The focus is on supply and demand instead of worrying about dozens of variables that influence price movements. So we start with charts and price action. Most of us that are traders today use our candlestick charts. Okay. Now, we're not here to learn about charting today, but remember, a candlestick chart tells us a lot about the markets. We see the open, the high, the low, and the close for each candle, each pattern. So the most popular type of graph crypto traders use is technical analysis, is candlestick charts. And it can seem intimidating at first, but it's easy to understand once you get the hang of the charts. Now, please don't get sucked into the reds and the greens. Even though the candles are reds and greens, seeing lots of reds or lots of greens doesn't tell you to do anything. Now, basically, a candlestick is made up of a body and wicks, and they tell you about the whole movement of that price during that period. So they're usually the rectangles, either red or green, which is the body of the candle, and then the lines coming out of them at top and the bottom are called the wicks or the shadows. The size of the candlestick and its line or its wicks, as well as the color, tell you crucial information, and they are part of technical analysis. The top and the bottom of the candlestick's main rectangle are the opening and closing prices of the cryptocurrency for that day or that period. Now, green candlesticks indicate that the crypto rose in value. So the opening price is at the bottom and the closing price is at the top. Green is positive. If we see red, we see the exact opposite. It closed lower than it opened. Now, the reds and greens are unimportant. They tell us whether they were bearish or bullish sessions, but if you want to use yellow and pink, that was perfectly fine. When I started trading, we used black and white because we didn't have all these colors and we didn't have computerized charts. And we were hand charting. So if it was a bearish session, we'd use the side of a pencil and color it in. If it was a bullish session, we would just leave it hollow. But these candlesticks and the size of their bodies and the length of their wicks can tell us a lot about the markets. They can also help us see how volatile the markets are, how big the price swings are. So at the most basic level, you can use candlestick charts to see how the cryptocurrency in question did to make the predictions for the future. If, for example, the wicks are long, this indicates a highly volatile market. That in turn means the cryptocurrencies have a higher chance of having given you significant losses or gains in that relevant period. Furthermore, high volatility means the market may correct this tomorrow. When the candlestick wicks are short, however, this indicates a potential change to the markets. So we have the wicks and we have the bodies. Okay. When wicks are small, means it opened and closed pretty close to the highs and the lows. When the body gets shorter, we get less play in the markets till we get indecision. As the bodies get smaller and smaller, that means the markets are less decisive. Then once we have our charts, we understand the charts, we need to start by putting lines on our charts to help us interpret what cryptocurrency is telling us. And the first set of lines we want to use is trend lines and support and resistance lines. And all of this is the basics of technical analysis for cryptocurrencies. Now, we all should be able to put these basic lines on our chart Because if anything, if we're not using all those technical indicators and oscillators, and I know all of you would like to know all about them, but they are the last phase of technical analysis. RSI, stochastics, MACD, all of that comes later because indicators are the interpreters of the market. When you can't look at your chart and you can't see what price is trying to tell you, then you might want to apply an indicator, an oscillator, as your interpreter. So one of the first elements of technical analysis trading should be learned to put trend lines. Trend lines indicate the direction that the cryptocurrency moves, but they require some analysis to determine. Now, a trend line and a trend are two different animals. A trend is a general movement of the markets. So when we say you should always be trading with the trend, because if the market's moving up, you shouldn't be selling short. If the market's moving down, you should be selling. The market's moving up, you should be buying. You shouldn't be a counter trend trader. Believe me, statistically, overall, you won't make any more money by being a counter trend. In fact, you'll make a lot less money. But then a trend line is a rule-based line that is the basis or the basics and the first step of applying technical analysis to your charts. Now, a trend line moves in the direction the price is moving. If price is moving up, the trend line goes underneath prices. Now, the rule of thumb is that price cannot at any time have broken that trend line. If it has, that trend line is no longer valuable, thrown away, and you draw a new trend line. A trend line, to be valid, has to have a minimum of 3 touches of that trend line. Now, you can place many, and we do. I draw many trend lines on my chart, and I'm constantly adjusting and moving, because as long as price doesn't break through it, you would look for the lowest low. Here we have our second touch. Okay, so we would have this trend line drawn, and we would extend it out into the future. Here we get a third touch. That's telling us that this is a valid trend line, and then we should be able to rely on it. And as you see, price remains above this trend line, even came down here, dipped on it, and then bounced back off to continue its uptrend. Okay. The minute, if price would have broken through here, down here, this trend line would have been over, and we would have had to readjust it and then revalidate it. But that trend line is ultimately important because it's your first piece of information you're putting on your charts that's helping you interpret what price is saying, because price is very hard to see. And this is particularly true given the volatile nature of cryptocurrency. Thanks to that volatility, technical analysis needs to find the overreaching trend going up or down amidst the smaller highs and lows. To make it even more complicated, trends can move sideways. Sideways trends indicate that the cryptocurrency has not moved significantly up or down. Now, keep in mind that most of the time the markets are just a random mess. When you can draw these trend lines on your charts and isolate these trends, this is the time you get non-random movement. When you get this non-random movement, you are now able to apply these rules and these analysis for high probability trades. Okay, it's only in these non-random, because this is when you can say, okay, we have this non-random behavior starting. So now let's use that to our advantage and to apply some of our rules and get some reliable trades. We can get real entry points, real exit points, real stop loss points. Otherwise, you're really just guessing and trying to use a chart to make guesses. So most software that you have out there, most advanced charts will help you or give you automatic trend lines, but you still have to adjust them to get them more accurate. Once you've got your trend line on your chart, we want to come up with support and resistance. This is another concept to understand about technical analysis, and that is support and resistance. Both of these are horizontal lines you can draw onto your trading chart to gain insight into the value of the cryptocurrency. Now, support and resistance lines stay on your chart for basically forever. They are the points around price where it has had a significant reversal, has a significant burst. It's had time where it stayed there for quite some time. It's had times when it's been moving up, it stopped and got stuck for a few minutes. You can draw as many lines in your chart because you're looking back historically and you're looking to see the last time Bitcoin was at 34.5. What were the price variables? Where did it get stuck or stopped the last time it was in this range? Okay. Then at 34.6, what price was structural there? And then you have major and minors. These are the floors on your elevator going up and down. The only way you get them is if you look at a 100-story building and want to analyze how that elevator moved up and down, you would have to watch it as it moves up and down and see what floors it stops on, whether it stops on them a lot in the afternoon or the evening, whether it stops on them once a month, whether it's, it goes up there and the elevator's packed full of people and that goes to that 102nd floor every time, 100 times a day, where it only goes to floor number 90 10 times a day. When you get this analysis and put it on your charts, you can start making some important evaluations about price. Support level is the point at which traders want to purchase. You want to buy cryptocurrency when it hits support. Now, support, if price had moved up 33, 34, 35, and we knew that 35 was an important level. Price, every time it got up there, bounced off of there and fell back down. That's not your support level, it's your resistance level. When it hits that resistance level, it's most likely going to come back to its next support level. Support level is where it was, like we know right now, 30 is a very, very strong support level. So we know if it goes down to 30, unless it's really cascading down, the probabilities are it's going to bounce off of 30 and move back up to where it had trouble the last time, bounce off of there. Doesn't mean it's going to stop. There's no rules that it can't go through, it can't crash right through, but it gives you a price point on your chart to mark and say, this is an important step in its movement. Now, a lot of traders, especially cryptocurrency traders, a lot of cryptocurrency traders are not versed in the overall financial markets. They haven't been trading other assets and moved to added cryptocurrency. Many of you guys are newbies to not just cryptocurrency, but to financial markets and to charting. So again, like changing technical analysis to chart analysis, I like to get rid of the word support and resistance. I like to call it price levels, because having to deal with the concept of what was the support or the resistance, it's like an elevator. Imagine this elevator goes up. You get in on the ground level, and what is supporting you? What is pushing you up? The floor below your feet. What do you have to break through to get up to the next floor? The ceiling. But when the elevator is going down, what do you have to do? That floor is supporting you, but you have to break through that floor to get to the lower level. So it's really your resistance. And every time you bounce to break that floor, where is your support level? It's the ceiling. So when you're going up, the floor is supporting you and the ceiling is your resistance. When you're coming down, it's just the exact opposite. So you can get really, support becomes resistance, or resistance becomes support, depending on which way you're moving. So we just said that there are price levels, because I keep talking about 30 and 35, but imagine when Bitcoin was at 22, 23, 25, moving up towards 30. 30 was its resistance level because it had never gone through there. Okay. And then when it did go through, it fell back down and went back through. So it really just depends on what side. So you're more concerned with what price level is where you're going next and what price level is underneath of where you are. Now, if your technical analysis includes a breakout of support and resistance levels, it likely indicates strengthening of the current trend. So if you combine these elevator levels, these price levels, with your trend line, guess what? Now you have a set of horizontal lines and a set of angle lines intersecting each other, both of them trying to tell you something about what price is doing and market psychology. It tries to give you more. It's putting together this puzzle that you're looking at. Now, with cryptocurrency, we have one more thing that helps us figure out what's going on, and that's market caps. The cryptocurrency, in regular trading, like you're trading oil or gas, you can see volume. You're trading on the stock market, you can see the volume of shares being traded in a particular company. So if you want to know if Amazon stocks are going up today and you see volume is surging, that means there's tons of buyers coming in the market. Okay. Cryptocurrency is market caps. The cryptocurrency market cap gives you an idea of the coin stability when using technical analysis. To calculate market cap, just multiply the total circulating supply by the price of each coin. Cryptocurrencies with larger market caps tend to be more stable. Now, we also have to understand something called moving averages. Moving averages is the third thing that you're going to put on your charts. What a moving average is just what you all know, just what we learned in school, an average. If Bitcoin was trading at 35,000 at 11 o'clock, the close at 11, 35,000 to close at 12, 35,000 the next 1 hour, 35,000 next 1 hour. If we took the last 10 hours for a 10-period moving average, we'd add together the close from each of those hours, divided by 10, and guess what? The moving average was 35,000. If the end of hour 1 was 35, the end of hour 2 was 36, the end of hour 3 was 34, the end of hour 3 was and we add them all together and they still come to 350,000. Your moving average was still the same, okay? Even though the price was moving up, because what moving averages do is they take the noise out of the markets. They let you see more clearly. And then we have several kinds of moving averages. We have simple moving averages, which helps a little bit, but then we have what's called an exponential moving average, which gives a little bit more weight to the most current price. And when you plot those on your charts, you can then start getting the noise out of the markets to understand what price is really telling you. So exponential moving average are a type of moving average. This type is calculation more complicated. For example, you may give the most recent 5 days double the calculation coefficient of the 10 days before that. Now, don't freak out. There's nothing you have to calculate. You want to put a 20-period moving average on your chart, you click on moving average, put in 20, and it just does the calculation and drop it on the chart. There's nothing you have to do in technical analysis to actually mathematical calculations. But you have to understand what makes up these pieces of information. Now, all of these are indicators. All of these are lines. But what makes them up? Because the only way you'll be able to interpret what they're trying to tell you is to understand what makes them. Now, say for moving averages are pretty simple, but there's a rule of thumb in the markets. It's called red light, green light. If the price is above your moving average, you would only buy. If the price is below your moving average, you would only sell. Then you can use double moving averages for crossover strategy, which is one of the oldest, most unique strategies, where you use a 10 and a 20, a 30 and a 60, a shorter period and a longer period, and they might tell you something about the markets. Now, ideally, we want to combine these pieces together. We want to look at our candlesticks and read what they're telling us. We want to look at our support and resistance. We want to look at our trend lines. We want to look at our moving averages. But ideally, you should never rely solely on technical analysis when trading cryptocurrencies. It's best not to use any single analysis method alone, as this gives you a limited information. So this is particularly problematic with cryptocurrency trading, since factors like mining, hash, and regulations can be a a significant impact on the coin's price. But technical analysis does not account for them. So put simply, traditional trading indicators are tools used by traders to gauge market sentiment. Such indicators, and I know this is what you guys have been waiting for. Everybody always wants to talk about indicators. Such indicators can be used in many different markets, such as for trading stocks, foreign exchange, and for, of course, cryptocurrency. While many crypto traders simply holding term, trading requires a multitude of data points on which decisions are based. Trading on emotion is never a good idea. That's why trading indicators have been an essential tool for all traders' tools, including cryptocurrency traders. Cryptocurrency trading indicators are therefore simply regular technical analysis trading indicators used in the cryptocurrency market. So one of the most popular and one of my favorites is called MACD, Moving Average Convergence and Divergence. It's got a great name. I think that's why I like try using it. But it's very reliable. It's one of the few indicators that adjusts quickly in short-term markets. Now, it starts off using two moving averages to build and goes on from there. Then we have Bollinger Bands. Bollinger Bands was created by John Bollinger in the 1970s. It was great for stocks. It's tested the time, the turn of time. And as the Forex market started to get more and more popular, Bollinger Bands was found to work extremely well in interpreting Forex market. And it has dropped over just as well, because one of the things about Bollinger Bands, it helps us see the volatility of the asset's price. And since cryptocurrencies can be so volatile, seeing that volatility on your charts in an indicator can help you understand what is happening. Then we have the popular RSI, Relative Strength Index. Relative Strength Index is what we call a bounded oscillator. It'll always come out between 0 and 100. When it's below 70, between 70 and 30, it's telling you an asset's overbought. When it's below 30 to 0, it's telling you an asset's oversold. It's measuring the momentum of the move. Now, sometimes trading is compared to gambling. For those that invest blindly into an asset without research or concern of the market conditions, this may be the case. When you do due diligence, technical analysis, fundamental analysis thrown to the wind, one might well be in a casino. Therefore, the highest quality crypto indicators can be the difference between life-changing gains and missed opportunities. Using indicators, using your charts, using these analysis tools take you out of that casino and take you out of that gambling atmosphere and put you into a trading investing atmosphere where it's no longer the roll of the dice. You're analyzing your odds, your high probability trades, you're making sense of what price is telling you, and you're making intelligent, smart trades, and you're using risk management tools to lower your risk to increase your probability of being successful. There are a wide variety of crypto trading indicators out there, displaying a vast array of metrics. Often traders will use multiple trading indicators to gain a fuller all-round perspective of market sentiment. Technical analysis can give cryptocurrency traders insight into the past of crypto, facilitating future predictions. Most charting software has numerous technical analysis tools built into it, and you can supplement these with your own analysis. For the best results, try to combine technical analysis with other methods. So on that note, I'm going to say goodnight to you. Thank you very much for joining us. Thank you for being part of the Invest Markets family. And to be honest, if you want to learn more about technical analysis and trading cryptocurrencies, if you go to investmarkets.com and either click on the live chat button, send us an email, or just go over to our charts and go to look at our education section, you'll find everything you need. But if you click on the live chat, one of our professionals will be glad to talk to you and glad to answer any of your questions. So thank you very much for joining us tonight, and have a successful venture into the world of cryptocurrencies. Good night now.